I am JB Bryan. I'm going to start recording this for our YouTube channel. Yes, indeed. JB Bryan, I am the President and Chief Investment Officer of JB Bryan Financial Group, the home of AfroEconomics. And you can call me at 1-833-275-2376. Yes, indeed. That's 1-833-ASK Afro. Thank you so much for hanging out with me tonight. I love the topic, because I really thought about this, and I'm also going to share it on CBS on Monday. I'm going to put a little different swing to it, so it's coming to you first before it gets to television. Now you know you are important, right? You are indeed. How you doing, Courtney? Thank you for hanging out with me tonight. Make sure that each of you do like the people participating in the webinar. Go to AfroEconomics.com, go into events. And I have decided that if you don't join AfroEconomics, especially in the no excuse category, then there's no excuse for you because it's absolutely free. Just like it is designed for you when you are at the stage of getting to know me or deciding about making a step in having a financial consultant, but definitely take advantage of the no excuse, free, complimentary, it's on me membership so that you can have complete online access. And you join, you get to download the ebook, you get to download, you can do so many things. So one day, that's why I have one day a week, every week, the members only. Well, there's no such thing as everything. Most weeks, we have our members only meeting on Friday mornings, sometimes on Saturday, sometimes on Monday night, but typically it's on Friday morning for our members only meeting. And it's discuss some things that are of relevance, that are timely, and I want you to think about. So I wanted to open it up to everybody. I don't want to leave this planet without offering the opportunity to everyone that you can get empowered through AfroEconomics and help me destroy the wealth gap in America and abroad. Destroy it. And it's going to take us focusing on our finances with a newfound confidence and freedom. And we can do that. So the diary of a moneymaker. What do you write in your diary all the time, right? Well, this particular diary day is about how automation can slow you down or even cost you. You know how you can just get into a habit of doing something the same way all the time and you just get comfortable with it? Well, now it's about doing something different all the time. I want you to meet a friend of mine that is in the studio with me. She is Jenny Jones. I want Jenny Jones to come because I want you to know an example of ever-changing life, like not putting yourself, come on, Jenny, not on putting yourself on auto mode. Jenny's coming in. She's a member. Come on, say hi. Look, say hi. Say hi to Barbara, Demetrius. Look at that. So you have friends.
Wow.
Yes, Jenny?
How friends? How are you?
You can tell though. Look and see how much shorter than you are than me. Look at that. You can't even see your face. The camera, I can't even bring it down. Look at that.
Well, I'm not going to talk long, but I just want to say Happy New Year to everyone. And I'm excited to be in the studio with JB today or this evening.
Look, Maurice said, hi, Jenny.
Hi, Maurice. How's you? It's exciting being here.
Oh, I appreciate you.
I'm just having an awesome time just being with JB and wish you were here.
Oh.
And so I'm not going to stay long, and I will see you at our next meeting. Okay?
Would you agree that life is ever changing?
Life is ever changing, and my life has changed since I've been with this brilliant young woman.
Thank you. Thank you.
And I know you all feel the same.
Thank you. Chelsea, come here. Let's see what she thinks. Now, see, this is a little girl. She's a little girl. Little child. Little child. Is life ever changing?
Always.
It's always changing. Always changing. She's so smooth. Always. Look at that. Oh, exactly. Good for you. Oh, look at this. See, you can't do like Jenny Jones because you're young. You don't know what to do. You saw like Jenny Dick. What can you do? Say hi again.
Just learn and progress.
Look at that. Maurice didn't even say hi to you.
I know.
You ain't say it right.
Okay.
Maurice said hi, Jenny, and that's how you ain't getting nothing.
It's okay. It's okay, you guys. I'm here for her. I'm not here for you guys. I'm just joking.
Look, I started to say something ignorant, but I'm gonna say it. But I'm gonna say what I started to say.
Hope you guys enjoy the webinar.
All right, exactly.
Bye.
See, she saved me. I didn't say anything ignorant. Hi, Jermaine. We were talking about change and not getting into auto mode. And definitely, Delia wants to say hi. Come on, Delia. Come on up to the wheels of steel. Say hi to everybody. Look, say hi.
Hello.
These are the ladies that make it all possible.
How's everyone doing?
Right. Oh, see? Nope. Jenny is the only one. Oh, Maurice said hi, young girl, to Chelsea.
Oh, to Chelsea.
He can't type really fast.
Oh,
he didn't get to.
Okay.
Obviously.
I'll wait.
You know, he just got that job back. No, we just picking on you. We're just picking on you. He's worked. Look, it's a hard working man. He don't have to work. He's just working because he wants to work. That's right. Hi to everybody on the call. Hi, Akila. It's so good to see y'all. So we're talking about how life is ever changing. Everybody that I was just introducing to you can tell you all these different stories. I know that each of you can tell your stories. So we have to make sure that our money is just like our life. How we have to make sure that we adapt to changing things in order to keep our money on pace with our long-term financial goals. So a first tip for my diary of a moneymaker, I want you to make sure that you write in your diary to log into your account. Log in. Do you know how many people I meet with and they don't log into their account? Most, especially your work plan. If you're putting money in there every pay period, do you have your login? Do you know your ID? Do you know your password? Do you know the website name? You know, a lot of times when we sit down with the members, that's what I'm doing. You know, helping them log in, looking at their investment options, making sure, but logging in is the first step. A lot of times all of the information that we need is in that login where we can find historical performance. We can find trading symbols. We can find any distributions that that you've made. We can find outstanding loans and interest rates and payments that you're making. I can find so much if you know how to log in and to make sure that you're not on just auto mode. You have to go, oh, well, I don't log in, but they send me, you know, a statement once a year, or they, you know, that's auto mode. And that's why I'm saying that automation can cost you. Not to mention the fact that you can be on auto mode and you haven't even considered the increasing your contributions. You're not even thinking about it because you started 10 years ago with $50 a pay period. Now, hopefully your income has increased and you never thought about increasing your contribution, because that's the cost of automation. That's how much it can cost you, right? You have to be, you know, about, how you doing, Ms. Jones? Make sure that you're about keeping up with any changes that they have. Get out of the auto mode. You know, that whole like set it and forget it, and that little rotisserie oven, people would just put it in. They wouldn't even look back on it. Well, now they have like those lifestyle mutual funds where they kind of get you into that mindset of just set it and forget it. But when you do get into, say, a 2030 fund and you never think about it, and the next thing you know, you're in 2025 and the portfolio that you're in is a lot more conservative than you want it to be because you put it in auto mode and said, I'm going to retire in 2030. And so its job is to say that you're going to retire in 2030. So it's reducing the equity position in that fund because you've set 2030 as the goal of when you're going to actually be using it. So you have to be careful with these automation because you have to still manage things even though you set it up to automatically take things out or automatically go into that fund or automatically make these changes for you. Be careful, be active, log in, get your password, get the details, join, start a consultation, join on the higher level of individual or family membership so we can do the comprehensive financial planning together. But just make sure you join and take advantage of that free membership if you can't afford to do the consultations at this point. And then a second point is to understand your dividends. Now we're talking about how automation can slow you down or cost you over time. Well, if you have individual stocks or stocks in your work retirement plan and you've set it up where it's automatically reinvesting the dividends, do you understand what you're doing? Do you understand that you're constantly buying that same stock? Like, do you have options of other things that you would like to do with the dividend? Do you want to accumulate the dividend into a money market so that you could actually purchase different investments with it? So you might want to have the high dividend stock that pays a dividend, take the dividends, put it into the money market, and then buy a more aggressive stock that doesn't have a dividend with it. But what happened is you said, oh, dividend rate reinvestment is everything. And you got into the auto mode and you're just buying and accumulating your position all in this particular stock. And I think about that utility company in California that's now filing bankruptcy. As with Enron, people think that it's a utility company and it can never go under. And I was talking to a client that has a huge position in a utility stock. Now, of course, overall, this doesn't happen to a lot of, them all, but I don't care what the company is, having an extreme amount of your portfolio in that stock, exposes you to a lot of risk. And when you're reinvesting the dividend, you're even increasing your exposure to that. You know what? All of your eggs in one basket, seriously, that could work for a while, but if it doesn't work, it can be devastating. So is the risk exposure worth, taking? Is the return really worth it? A lot of times the return and the dividend really isn't even that good. I had people that have huge positions in Lucent and then they would say, well, they just gave us the stock, so it really doesn't matter that you have all this. And I would say, yes, it does matter. And then Lucent ended up going under. It really does matter. It's still your money, and you still did earn it. Even if they gave it to you, it's because it's part of your compensation. So manage everything actively. Automation can cost you. Just because it's what you've always done, it doesn't mean that's what you need to still be doing. Life can be full of improvement, as everybody on the AfroEconomics team that's here with me tonight mentioned as well, right? Moving forward. Forward moving, right, Delia? That's what she Our third point is to understand non-correlating assets. Things that if you have a portfolio that's all in equities or all in a particular equity, as I was referring to, say it's all in a utility stock. Well, even if it weren't all in the utility stock, maybe you would have been helped if you didn't want to take it out of that asset class. You could have been helped just by having it in another type of stock other than that. It could be, something that's in technology, or it could be just a consumer goods stock, or it could be a retail stock. But you have this whole class of equities that you still need to diversify within that asset class. But non-correlating asset groups, it's like a stock versus bonds versus real estate versus cash. So you could have real estate and a stock portfolio and some bonds in there, so that they're all not moving. The goal is for them not to be moving all at the same time in the same negative direction, that when one is going down, you want the other to be going higher, because just in theory, what does the stock market have to do with the real estate market. But in reality, even though they're seen as non-correlating, they still are impacted both by interest rates. So, non-correlating is difficult, but because, there's always some sort of correlation, in anything, really, if you look deep enough, but at least it's a lot less than having all stocks. And then if you make an effort to say, I want to be diversified across asset classes, that is getting out of that automation mode. Not just saying, this is the way I've always done, and that's the way I'm always going to do it. And I only buy CDs, and that's what I do, because it is like, the situation that I'm saying is about, most of us being in stocks, that's, not what happens. If anything, we're not in it enough. We're not getting the opportunities. We're not taking the opportunity to get in growth asset classes like equities so that we can benefit from the stock market. It has to do very well. And I'm just talking about just as a norm, like we just aren't confident about the stock market. So, that's why AfroEconomics is so important, because we're talking about it. And the fourth point is to control your diversification and asset allocation. And as I was mentioning, and when was just talking about non-correlating asset classes, but when you control your diversification, you're actually looking into your diversification deeper. Like, just because these are all stocks, have I diversified within the stock asset class? So I don't have all the same type of stock. Have I diversified my bonds where they're not maturing all in the same year? So having control over that and understanding that, the fact that we think, or even diversifying with our mutual funds, like we're much more likely to have a mutual fund than an individual stock, but your mutual funds are made up of investments. Do you know what's in them so that we can diversify? Many people are over diversified. They have like 10 mutual funds, all of them with the same components. We only have like, some of the best, strongest companies, out there. In any good mutual fund, it's all going to have it. So if you're doing a mutual fund, you just want to try to see if the manager is bringing anything to the table. So I put together portfolios because my goal is for my management skill of the portfolio to outperform just those funds individually, and to address your time horizon and risk tolerance through the portfolio. So that's my job, to make sure that I have some non-correlating asset classes, that I have diversification, and that we have an understanding of the different asset allocation and why asset allocation is important, because asset allocation really has a big impact on what return you get. If you decide that I want to have a portfolio with 90% bonds, then historically you had a lower return than a portfolio that had 90% stocks. So your asset allocation has a big impact on your ability to have growth and to outperform the cost of living. So, and all we can base things is on historical performance. Historical performance is no guarantee of future results, right? Like a commercial. But indeed, there's no guarantees on what the future will bring. But we have to not get lazy. We have to make sure that we stay on what's going on. So it's automatic. So you're doing this every month, but what are you doing every month? How often do you look at it? Make sure we do the quarterly reviews. That's why quarterly is good. You get lazy if we put it too long gaps in between things. So quarterly is good. And that's what we do with the membership, to just quarterly review on the risk tolerance, quarterly review on the your contributions to work, quarterly review on what's going on in your financial life. We got to catch up. And then understanding rebalancing. And some of these are like terms that we've never thought about before, because they put you in auto mode. They said, just set it, forget it, don't call us, don't ask no questions, hey, leave us alone. But the ones who are really on top of their games are calling those numbers or joining AfroEconomics, getting the help that they need, that ultimately, how well we manage anything, even if it's a house plant, you water it regularly, it grows. That's on everything in our life. You take care of your hair grows. You take care of your marriage grows. You take care of your child grows. You take take care of your money. I can't guarantee it, but you need to take care of your money. That's the goal, that your money will grow. So understanding rebalancing is how we balance the portfolio in the beginning. Say it's 80% stocks, 20% or stocks or stock portfolio, stock mutual funds or stock ETFs, or it's just 80% in growth investments, 10% in bonds, and then another 10% just you want in cash. Well, all of a sudden, bonds do very well, theoretically. Just say that happens. And then all of a sudden, your stocks don't do well. So your stocks become 60 and the bonds become 80. Well, rebalancing means we got to get the stocks back to that 80, to their 80 position, because of the value of the bonds going up, it changed your balance in your goal that you wanted to have more stocks in your portfolio. So you can set it up to automatically rebalance. But what if because you set it up automatic and you're not actually actively taking care of it, it might happen, but you didn't want it to happen. Like I had that happen for a member came in and I was analyzing what he had, and he had an annuity. And when the annuity renewed, it totally switched their allocation from having the index exposure, and it reduced the index exposure and increased the fixed interest rate exposure. And he had no idea that it happened. But hey, it's not in auto mode no more. We're on that thing. We are taking care of it. So understanding rebalancing is a key part of the diary of a money maker. Because automation can slow you down and it can cost you, indeed. I got all into that. Did you ask me any questions? Oh, I'm so glad, Don. Donna's hearing sound good. Donna's all good. Akila, how you doing? Thank you all. Oh my, and thank you to everybody who is on the AfroEconomics with JB Bryan on Facebook. But these are some things that I will check you out when we finish, and Delia and Chelsea are over there checking on you, so don't feel it. But I totally want to encourage everyone to come in on the webinar side, because the participation over here is fabulous tonight, y'all. I remember when it was just you and me in the screen. Yeah, so look, I thank you, and I thank you to all of y'all who go way back with me, like Don Tice. I appreciate you. Thank you. And thank you to the callers as well. So I want to make sure that we just go over real briefly. How you doing, Dr. Arundel? I see you, Ms. Jones. The Diary of a Moneymaker, my emphasis here, my thesis statement is to just say that don't just set your money and forget it. Don't get into automation mode, because that can slow down your growth, but we don't think so. Because, people say that story and they feel so proud about it. Girl, I started that when I first got my job, and then now 30 years later, look at all I got. But they don't want to hear the story, do they? They don't want to hear the story about if you have been increasing that every time you got a paycheck, imagine how much more you would have had. So, if you had been managing it, if you had an understanding of how the equities in your company stock was working, how the mutual funds were working, how the non-correlating asset classes can work together and help you through some of those, the volatility that you experienced over the years, and then how you need to have a control over diversification, and how you might have all of these funds that are representing the same asset class, and you don't even know it. And you never understand the need to rebalance. And so you have a whole bunch of your portfolio that totally switched over time because of what outperformed and what underperformed, and you never really managed it. That's a problem. And nobody on this call will ever say that. Don't go into auto mode on anything on your life. Make sure that you create the life that you deserve. Build the portfolio that you deserve. Follow the principles of AfroEconomics. Make sure you do the No Excuses membership if you don't do anything else, and get the ebook. It's automatically free. You'll make sure you do that. And then I want everybody on the planet to read the book, to know the 10 principles. We just did the DC. Thank you to everybody that came out. The DC on Saturday, it was Living the Principles of AfroEconomics, a powerful room. And I just thank God for using me to bring such powerful people together. But the 10 principles are right in the front: legacy, self-reliance. And tonight is about the 4th principle: knowledge. What you don't know can hurt you. Yes, indeed. Rest in peace, James Ingram. Yes, indeed. And I saw him in several concerts. He was the man. And life is short, y'all. Make sure you get everything straight. I don't know. I guess, I don't really like saying life is short. No, life is life. So live it properly. Live it actively, right? Right? Life is life. Just maximize it. Yes. Thank you all so much. And you all have a wonderful night. Email me at jb@jbbryan.com if you have any questions. jb@jbbryan.com. Stay positive. Thank you. Oh, Janice said hi, everyone. Thank you, Dr. A.